our first session, the keynote speaking session with Mr. Wadhwa. Before that, I would just like to introduce the moderator for the session, Mr. Kalpen Parekh. Mr. Kalpen Parekh is the MD and CEO of DSP Investment Managers Private Limited. Mr. Kalpen Parekh has over 2 decades of experience in finance and asset management. Prior to joining DSP, Mr. Parekh was responsible for growing the business at IDFC Mutual Fund, Birla Sun Life Asset Management Company, and ICICI Prudential Life, Asset Management Company. So basically, Mr. Kalpen has worked across all the top AMCs of the country. He is quite passionate about behavioral finance and believes that investor behavior is one of the most critical aspects to a good investment experience. Mr. Parekh has undertaken various initiatives in the organizations that he has worked with to highlight the importance and learnings of behavioral finance across the value chain. Mr. Parekh holds a master's degree in management studies in finance from Narsi Monji and a bachelor's degree in chemical engineering from Bharati Vidyapeeth, Pune. Mr. Parekh, the screen is all yours.
Thank you, Kishore, and welcome everyone. I wish my introduction was shorter so I can do justice to introducing Ashok and hearing a lot more from him. So we have today evening Mr. Ashok Wadhwa, Group CEO at the Ambit Group. And all of you know the group is a very dominant name across investment banking, institutional equities, SME lending, asset management, as well as wealth management. And it is very timely that we have Ashok as our keynote speaker for the theme of the conference today, which is about challenging the conventional. And when I was trying to just, learn a little bit more about Ashok a couple of days back when we came together to introduce each other and ask him, I realized the unconventionality that comes along in his profile. So while he is a chartered accountant who became the youngest partner at 29 at Arthur Andersen, and this was also, a phase. I come from a family where my siblings are both chartered accountants. I am the only one who could not become a chartered accountant. So I'm fairly, insecure about that fact when I'm talking to such an accomplished CA and introducing him. But, in those days, I remember the profession was seen to be more boring and, the ability to attract talent was always a challenge. And in his early stint over a decade, Ashok, when he co-founded RSM, built one of the best world-class practice where some of the best CAs, aspired to go and work for. So that was, I think, the first stint of unconventionalism that he perhaps brought to that profession. Apart from that, not many would know that, India has recently succeeded in cricket under the, guidance of Ravi Shastri as a coach. He happens to be a very close friend of Ashok. They were both batchmates, and Ravi wanted to be a CA, and Ashok wanted to be the cricketer. Perhaps India would have been more accomplished in that case if that ambition of yours would have been successful, Ashok. I think few things that I want to highlight, which I picked up about him, and which is also known to a lot of you, but to those who don't, coming from the world of investment banking, one thing that he highlighted that he really stands for is honor and word. My word is my trust and my honor. And this is a statement that he very proudly made when we were chatting a couple of days back. And I think these are some principles which, we all in our business of fiduciary money management really aim for and value. So Ashok, such an accomplished, career journey. We are all looking forward to hear from you informally your professional journey and how have you navigated to build such world-class businesses as well as organizations in a very diverse set of money management businesses across investment management, asset management, wealth management, as well as doing some of the marquee deals in investment banking. So with that backdrop, we are all looking forward to learn from your wisdom and from your experience. And I know it's coming straight from the heart because you mentioned you would prefer to do that, not just have a presentation. So over to you, Ashok. Thank you.
Thank you, Kalpen. And thank you, CFA Association, Navneet Munot, for inviting me as your keynote speaker. It truly is a pleasure and an honor. My first question when Kalpen was talking to me related to, can you just help me understand my audience a little better? In the world of real conferences, I could see my people eye to eye and tailor my presentation to the benefit of the audience. Here, unfortunately, in a virtual world, everybody is a name, and some are names and faces. Becomes a little more difficult. I was told that the majority of large part of the audience in today's conference was students, upcoming and qualified CFAs who were in the early stage of their career, and then of course many who have already accomplished a lot in their own career and are in positions of both leadership and command. So I tried to break my presentation in a manner that kind of suits both sets of audience. Somehow I must tell you, one of the greatest pleasure for me at this stage of my life is to talk to audience, which constitutes students, younger professionals, aspiring individuals, and often now young entrepreneurs who have got a new term called unicorns. And I'll keep that perspective in mind, Kalpen, as I talk to my audience today. Let me start, you spoke about Ravi, and let me start by something I have always believed in. It's very true in my career. And therefore, ladies and gentlemen, to those who are aspiring to build a career, whether in finance or otherwise, here is one fact of life. People always believe that successful careers are built on the back of a very well thought through and a designed program. Perhaps true. But I would like to challenge that and also say that as many wonderful careers have been built on what I would call default opportunities. What do I mean by that? Let me start with two typical examples for you, ladies and gentlemen. And I'll avoid giving my example because I'm a case of multiple defaults. I began as a chartered accountant, wanted to become a tax professional, became an investment banker, and now have managed businesses which I knew very little about. And to be honest, some of them I don't know adequate even now. But let me start by two other examples. You spoke about Ravi. Ravi is a classic case of an individual who grew by default. In 1981, when Ravi was invited to go to New Zealand, a pure default, he was nowhere in the line of becoming a player for the Indian cricket team. Sunil Gavaskar used to like him because they used to play together at Matunga Gymkhana. But beyond that, and Ravi was a good left-arm spinner, but beyond that, really nothing more accomplished. Unfortunately for that 1981 tour, Bishan Singh Bedi, who was a primary bowler, many of you may not know these names, so please do Google them. Bishan Singh Bedi, who was a primary left-arm spinner, had decided to skip the tour, and therefore the number 2 skipper Dilip Doshi was playing for the game. In the first test, he got very badly injured, and therefore they needed a replacement. The next replacement was a guy called Padmakar Shivalkar, who used to play for, we called him Paddy Shivalkar. He used to play for Bombay, one of the most prolific cricketers of the time. I mean, Paddy Shivalkar would have made a cricket team anywhere else in the world, but not in India, because India has abundant of spinners at that point of time. And Paddy, unfortunately, had lost his father that week, so he couldn't travel. And by sheer default, the chance came to Ravi Shastri. Ravi flew to New Zealand, and he went there as a left-arm spinner. And he took wickets of number 8, number 9, and number 10. 3 wickets in the game, but 8, 9, and 10. And then he became a sudden hero. But that's not important, ladies and gentlemen. The point I'm trying to make is each one of us is offered an opportunity in life. Question is, do we see it and do we capitalize it, or do we don't see it and don't capitalize it? Interesting thing is that this was 1981. In 1985, Ravi won the Champion of Champions trophy in the first Champions Cup that India won in Australia. And believe it or not, the number 11 batsman was chosen Champion of Champions because he scored 350s and 100, opening the innings for India. So in a space of 4 years, the number 11 batsman went to become number 1 because India didn't have a second opener with Krishnamachari Shrikant at that time. Ravi was offered the opportunity. He grabbed it and he took it on. That is what I call successful career, not necessarily by design, but by default. Opportunity came, he grabbed it and he grew on it. Sometimes we all need to be aware of, cognizant of these opportunities and take advantage of it. Let me give you another example of a wonderful person. We all know him. His name is Parekh, a person whose career is perhaps based on the other factor of design. I still remember in 1998, I was walking the street of New York with another iconic individual, Jerry Rao. Jerry had just started a company called Emphasis. Many of you may be knowing Emphasis has been sold a few times over, was owned by Bearings last, and then Bearings sold it more recently in a very large multi-billion-dollar deal. And I asked Jerry a question. We were talking about Deepak and we were walking on the streets of New York. We just finished a meeting with Warburg Pincus for his first private equity raise. And I asked Jerry, I said, Jerry, how is it that despite being in an industry which certainly in 1998 was plagued with a lot of controversy, Mr. Parekh has remained such an iconic individual. And he was an iconic individual even in 1998, not just in 2021, ladies and gentlemen. And he said, whatever Deepak does, he looks at a 25-year vision. What will the consequence of my action today be 25 years from today? Now that's really long, very, very long. I realize that in today's fast-moving world where unicorns are born every day, 25 years is a humongous period. But think about it, that even at that point of time, there was a leader who used to think 25 years ahead, which is why he has built HDFC into perhaps the most iconic and the one organization, if you do the maths, which has created more value for its shareholders than any other organization, perhaps in India. If you take the cumulative value of all the listed entities within the HDFC group, they probably constitute and provide a better return than any other group in this country. So the point I'm making, ladies and gentlemen, is that you have to understand that some careers are built by design and some careers are built by default. And neither one of them is right or wrong. Both of them, I would say, are equally right. But I'm here talking about what is happening and how is the world changing and what are the challenges of today's world. How do we look at the new convention that's evolving and evolving around us? And perhaps the best example of that is Reliance. I don't need to say much about it, but a company that began as a pure textile company in 1966-67 graduated to a petrochemical cracker company. I still remember the first cracker plant that came up in Nagotane. And then from there has now built itself into perhaps the most digitally developed company amongst certainly the Indian peers. Is a great example of how we must all re-emerge, we must all recreate ourselves at each point of time. My story in some ways is similar to that, very small way, ladies and gentlemen. I began as a tax professional and then went on to become an investment banker. Does it mean that I know every business that I run? Well, whereas Mr. Ambani is certainly an iconic individual and perhaps more intelligent than many Ashok Wadhwas of this world, I won't say that he knows every business that he runs as much, but what he does know is how to manage the variety of businesses that he runs. And I think that's perhaps one of the most important responsibilities of a leader in the new world. I would argue and say that any global leader today must first be the head of human resources in his organization, because recruiting the right talent, retaining the right talent, motivating the right talent, and understanding your talent is perhaps the single most important responsibility of a global leader in today's fast-changing world. From there, let me move to another important issue, ladies and gentlemen, that relates to the larger audience, what I call many of us, I would, for want of a better term, use a nomenclature called intermediaries. We are all intermediaries in some fashion or the other. Whether you are in the asset management business, managing money, whether you're in the wealth business, whether you're in the wealth business, distributing money, whether you are in the investment banking business, as I am, doing deals, we are all intermediaries. And I do genuinely believe that we have reached a stage and age of our life when we as intermediaries must stand tall. We have a very important responsibility. And the most important responsibility we carry as intermediaries, ladies and gentlemen, is that we allocate capital in a responsible manner. At a time when public markets are so buoyant, at a time when almost anybody and everybody is able to raise capital, it's an important responsibility of an intermediary. It's an important responsibility of an intermediary to ensure that they reach out to investors, that they reach out to capital allocators in support of companies that operate in a responsible and a fair manner. One of the things that people ask me is, why is it that we intermediaries, I'm an intermediary as an investment banker, why is it that we intermediaries perhaps gain a little less respect in a country like India than elsewhere? We have heard our Honorable Prime Minister, our Textiles Minister Piyush Goyal, who's himself a chartered accountant. We have heard them say that it is very important that chartered accountants, who are also intermediaries in some ways, act in a more responsible manner. We carry a very large responsibility for the future generation of CFAs, chartered accountants, MBAs, call it whichever qualification, ladies and gentlemen, that we continue to work for the upliftment of the intermediary credit that we carry with ourselves. As I said, whether it's a chartered accountant, CFA, MBA, it doesn't matter. And only we can help ourselves. And honestly, if today in some places we are looked down upon, it is because we have caused it to happen to ourselves, ladies and gentlemen. I would like to ask many of us, including myself, how many times are we prepared to say that this company is non-compliant with a particular regulation, or non-compliant with the ESG rules, or non-compliant with environment rules, and therefore we are going to refrain from working for a public offering of this company? I would dare to say that many of us would hesitate to take the position because we tend to put our commercial interest ahead of what we believe should be our larger responsibility for the profession that we represent here and anywhere else. I would like to believe that it is time, if we intermediaries want to be greatly respected for all the intellect that we bring to the table, for all the skill sets that we bring to the table. And there is immense amount of value that we create for our clients, ladies and gentlemen. Value in monetary terms, value in wealth terms, value in preservation of wealth terms. We create a huge amount of value. And if we want to be truly regarded for all the value that we create, it's very important that we look at the other side of it, which is the responsibility that comes, the accountability that comes with that value creation mode. In other words, we carry a responsibility on behalf of each of our professions that we uplift, and we can only do that if we act responsibly and in an accountable manner. So I would argue and say to all my peers and colleagues that it is high time that we as intermediaries also become responsible capital allocators, work with companies and encourage companies to do what is the best practice in the marketplace today and forever. We've seen that happen in many asset managers. There are asset managers today who would say absolute no to financing a coal plant. There are asset managers today who say, sorry, if the largest part of cargo arriving on this port is coal or any such raw material, then we are not going to finance or participate in fundraising related to that project. There are companies out there who say, as a part of our social responsibility, we shall not invest in companies that manufacture or sell liquor. And I'm not saying, by the way, I do enjoy my glass of wine, so I'm not a teetotaler. I'm not saying that this is right or that is wrong. I'm not sitting here in judgment, ladies and gentlemen. I'm saying each one of us needs to create that one basket of responsibility that we shall hold ourselves accountable to, and then pursue it very, very diligently at all points of time. Kalpen spoke about trust and respect. And I do realize that many of us on this call are probably intermediaries distributing, preserving client wealth, distributing different products, bringing different products to the marketplace. And I would say trust and respect in this context goes with another very important issue called client centricity, or subordinating your own interest to that of the client. Let me elaborate on that, ladies and gentlemen. I have been through multiple experiences. As a matter of fact, just today, it happened to us where we lost a mandate, and we lost a mandate because one of our colleagues tried to, I think, oversell the valuation of a particular asset. We're now in an era, ladies and gentlemen, where there is complete symmetry of information. That era where there was asymmetry of information, Google has made sure that there is complete symmetry of information at this point of time. As a result of that, it is very important that we always keep our client as the center of our attention. In Ambit, we have a famous saying, subordinate your interest to that of the client. If it's not good for the client, don't do it. One of the areas where we as intermediaries, particularly in the wealth piece, have taken a significant amount of, I would say, negative publicity is on the whole issue of overselling. And I'm not saying that we are not entitled to make mistakes. Honestly, all of us, ladies and gentlemen, are absolutely entitled to making mistakes. But the key issue is, are you doing enough diligence, and are you absolutely convinced about what you are selling to your client? And I would argue very much to you that if we spend more time doing diligence on what we take out and sell to our clients, then you will have a happier situation. You will have a happier client, and hopefully you'll have a better outcome in comparison to just taking a client, any product that is on the table. So we believe that in our business, building trust and business respect are two critical issues. Trust comes by demonstrating to the client at all points of time that you are prepared to subordinate your interest, and the client is the center of your attention. I still believe in that old principle that I'm available to a client when my client needs me, of course, avoiding any duplication. I still believe in that principle. And honestly, clients like to deal with people, in particular, as we see greater and greater amount of wealth getting created. And we're seeing huge amount of wealth being created in India, whether it is as a result of just the stock market movement, or indeed because some new technologies and some new opportunities are creating these new unicorns. Combination of both of them, perhaps, ladies and gentlemen. But as more and more wealth gets created, there is greater and greater responsibility on us to make sure that we are doing adequate amount of diligence and we win the trust of our clients through consistent, compliant behavior, which always subordinates our own interest as intermediaries to that of the client. The other is respect. Respect only comes out of having adequate knowledge, qualification, and domain knowledge. And therefore, I would dare say that as we go and present our credentials to our client, and as we go and make propositions to our clients, we ought to be prepared to have a intelligent and intellectual debate with our client on all those issues. It's for example, in the current environment where, technology is evolving at the speed at which it is evolving, I have at points of time refrained from participating in client pitches because I'm not adequately prepared and perhaps not adequately aware of the changes that may be happening in certain segments of this whole evolution process. And there's absolutely nothing wrong. I can only tell you this, ladies and gentlemen. In all my career, I have seen clients stand up and respect you if you tell the client, I'm sorry, I don't know this issue, or I don't have a resolution for this issue, or there is somebody else in my organization or outside my organization, doesn't matter, who is better qualified to be able to respond to you than I am. It served me well. It's helped me build trust with my clients. And as a result of that, my clients will come back to me and often seek advice even on issues where I may not have the right domain knowledge, but where they know that I'm in a position to or capable of guiding them as to where they go. So that would be my other very strong suggestion, ladies and gentlemen. You know, somebody asked me an interesting question recently. What's been your greatest learning and where have you got it from? And I have to say that my greatest learning has actually come out of my failures. I'm a great believer of the philosophy that failures teach you even more than success teaches you sometimes. It's just that you need to have the gravitas, the ability, and the internal strength first to introspect. Very important, ladies and gentlemen. Introspect. Every time you finish an action, go back and say, what did I do wrong? It's not about what did I do right. What you have done right, you don't need to learn. It is what did I do wrong? And perhaps there is nothing I did wrong, and perhaps there is something I did wrong. But whatever I did wrong is a teach for me on what I ought to do right the next time. I began my effort to build a wealth business in Ambit in 2011 for the first time. And it's now almost 10 years. It's only in the last 2 years that Ambit and its wealth business has really surfaced and is showing great promise to be able to grow to the opportunity that the marketplace offers today. I mean, I'm a great believer, by the way. For these 10 years, I must tell you, there's been regular debate within the Ambit board on whether wealth is a large enough opportunity in India. In 2011, perhaps it was true. But thanks to people like Karan Bhagat and IIFL, they demonstrated that their belief in the future of the wealth business in 2011, which is now so visible in terms of the value that they have created, was true. It was true in 2011. It's true in 2021. It will be even more true in 2031, ladies and gentlemen. I began the effort in 2011. I failed at the first attempt. I tried to rebuild it in 2015. I failed at the second attempt. And each time the Ambit board would debate and say, is it really a large market? And do we really have the right DNA? And it was not until 2 years ago when we recruited a new team under the leadership of one of our colleagues, your colleagues, Amrita Farman, that we really saw what the opportunity really was and how do you actually build scale in that opportunity. So for everybody's benefit, failure teaches you a lot. All that you need to learn from failure is what did I do wrong? Not necessarily give up the opportunity, but learn why you did not succeed. And then if you keep persisting, don't persist if there is no opportunity. Don't persist if you don't have the skill sets to be able to leverage that opportunity. But if you think there is opportunity, if you believe that you have the skill sets to leverage the opportunity, I think the future of the wealth business in this country is perhaps greater than the future of an investment banking business or indeed the equities market at this point of time. It's really large. If you look at the amount of wealth that is being created, somebody gave me a very interesting statistic, ladies and gentlemen. Somebody gave me a statistic to say that in the last 5 years, India has generated 30 unicorns. But in the next 3 years, we will have 150 new unicorns. Just look at the pace at which value is being created, and all that value will accrue in the hands of many individuals, very well dispersed. And that, in my view, augurs extremely well for the future of wealth management and wealth advice in this country. Let me quickly move on to a few other interesting anecdotes that I want to share with you over here. There are two other principles that I believe in very strongly. The first principle I believe in is that profit and losses are built in the short term, but businesses are only built in the long term. For a long time, there's been a lot of debate about how much investment do we need to make in any business. And if you look at current companies. I mean, let's take Zomato, right? Zomato is a good example of a company that got listed very recently. Their quarterly results showed a negative 400 crore loss. From the time that I came, it would have appeared that a loss-making business should not even be IPO. As a matter of fact, there was a SEBI regulation. I don't know how many of you remember. There was a SEBI regulation not until too long ago, where if you didn't have a track record of 3 years of consecutive profit, you were not an IPO-able candidate unless you met certain specific conditions. And we're now into an era where perhaps the next 10 most successful IPOs will be made by companies that have probably never made profit in this country. So I think, it goes to demonstrate that it's not about profit and loss account. It's really about building a business. It's about scale. It's about, and we believe very strongly, very, very strongly, that businesses can only be built in the long term. So one very strong recommendation to everybody is, please do not take any shortcuts. I mean, think about it, right? Look at the way Nykaa has built its business, slowly, one at a time. It's taken her 10 years to build the business. And in these 10 years, they have continued to remain invested and continue to remain invested. They did not step away from their strategy just because there was an Amazon or just because there was a Jio coming in. They have continued to invest and they have continued to build their business, which is perhaps why you will see how and why they will be so successful. Look at some of the old houses, right? Tata's is a very, very good example. Fortunately, in Chandra, they have a leader who understands technology, but his idea of bringing in a super app, the acquisition, for example, of Big Basket, we've always thought of Tata's as slow and steady, but here is a group that would have been and grew perhaps on a slow and steady trajectory for the longest time of their career. But when time has come to move forward, they have started looking at how to emerge stronger and more competitive through the acquisition phase. Big Basket is a great acquisition story. I would equally say to you that there are companies that have perhaps lost significant value because they did not take the right step or the right value at the right time. And there are innumerable examples of companies where they could have sold. I mean, there's an old story about Jet Airways. The rumor has it that at one point of time there was a proposition to buy out Jet Airways, but the attachment of promoters to their businesses, the desire of certainly some of the older time promoters to not see the changing winds probably cost Jet Airways the whole business. I mean, don't forget, at one point of time, Jet Airways was perhaps one of the most formidable and visible brands built globally and managed out of India. And for a iconic airline like that to be non-existent at this point of time, we keep hearing rumors about the fact that somebody is going to revive it someday, but I have my own serious doubts. But think about what ought to have been done at that point of time. I personally have been involved in quite a few airlines at transactions at different points of time. And I can say this to you, that it's a difficult business, and at the right opportunity, if you do not detach yourself from your business, whether it's an airline business or some other business, then I think you can have a significant loss instead of a value creation opportunity. And whereas the promoter may have the right to decide it on his own behalf because that's his capital, he ought to be more responsible and look at it in the larger context of a publicly listed companies, which is why I admire the companies who say that merger and growing is a better option. I remember the transaction that I did for Centurion Bank of Punjab. It's a little old, 2008, 2009 transaction, 10, 12 years ago, ladies and gentlemen. But a wonderful opportunity. I mean, at a time when Centurion Bank of Punjab itself had grown through a consolidation of a few banks, they were Centurion Bank, then they acquired Bank of Punjab, then they acquired Lord Krishna Bank. Instead of trying to grow and continue to grow, the management at that stage thought it was better to consolidate with a larger player and they merged with HDFC Bank. And at the point of time when they merged, there were many questions asked about why are you not kind of surviving and growing on your own steam? But they chose, as I said, to merge with HDFC Bank. And the value that the shareholders of Centurion Bank of Punjab created through the merger with HDFC Bank was a significant multiple of what they would have been able to create just on their own. So what was true then, I would argue, ladies and gentlemen, is equally true now. I mean, even today, when you look at mergers and you look at consolidation, I was talking to a family of businesses in Delhi, a private unlisted company called Control and Switchgear. And the family was, has been running the business. It's the second generation that is running the business now. And the family was very keen to continue running the business, but they saw a larger opportunity in combining their strength with a global major called Siemens. It was some persuasion, but without doubt, that consolidation has created a significantly greater amount of value for the shareholders of CNS than a standalone business. So I would argue and say, ladies and gentlemen, to all of you who are in the iBanking business, certainly, or in the equities business, that always keep, if value creation is the most important target for all shareholders, and it ought to be. It doesn't matter whether you are a promoter or a public shareholder. I think everybody has to be responsible for maximizing the value of all their shareholders. And if that's the important target, then never be close to the idea of consolidation and building value through the consolidation phase. What Byju's has done, what Akash did recently, is an outstanding example. Akash was a good company, well-funded. Blackstone was one of the other shareholders. But Akash realized that if the business was going more online from offline, then consolidating with an established player like Byju's was really the right opportunity. And kudos to Byju's, because having created a currency through their own stock and re-rating of stock again and again through multiple capital raises, they use their currency very effectively to acquire a segment of business which is very, very profitable, which has a very high growth rate, because specialized tuition programs or specialized learning programs for medical and engineering faculty are critical elements. So I would say, that's a classic example of how value accretion is happening, because people are keeping open mind and people are not hesitating in doing what is right for their business. Akash could have easily said, oh, but I've built this business, I'm very happy. Why do I need to consolidate with anybody? And there you are. So I would say to you that opportunities come in every way for everybody. We just need to be opening our eyes and I don't know, Kalpen, how I'm doing on time. Do I have a little more time, or?
I think 5 more minutes, Ashok, because we already have received many questions.
Okay.
It would be useful to have some time for Q&A as well.
Right.
So 5 more minutes.
Yeah. Okay. So I'll quickly go through 2 or 3 other things that I think I wanted to share with you. I'm aware that the subject of discussion today was challenging the conventional. So just let's think about businesses that were existent and that are no longer existent and what happened. So one of the businesses that I founded many years ago was a fund called GW Capital, which is now called True North. And in 2007-8, True North invested in a company called Meru. It was really only a license of a company called Meru. And I will give you a contrast with that from a 1998 example of a company called United Television. So United Television in 1998, Ronnie Screwvala used to make toothbrushes. And from making toothbrushes, he decided to go into television programming. Linear programming had just become the new thing. And he had a letter for a program called Shanti, which was the first program that Doordarshan wanted to put out as a primetime program. And I'm giving you the 2 examples in parallel. So here was Ronnie in 1998 with a letter called Shanti. He came to me and said, let's raise capital. We took him to Warburg Pincus, and Warburg Pincus invested in that company. And in 2008, there was a company called Meru in which True North invested money. Between 1998 and 2015, Ronnie probably went through one of the most, I would say, uncertain times. Uncertain in terms of in a year he would give great results, and then 2 years he would have horrible results. And in a year he would give great results, and in a 2-year period he would have horrible results. And there was a lot of debate about whether that was a success or not as a business. Eventually, with appropriate number of capital raises, he listed the company, and the company was then listed. But that company needed serious amount of support before it got eventually listed, ladies and gentlemen. The good news was that once the company got listed, and he had adequate capital, he did not wait too long to try and determine the future of that company. What Ronnie did immediately after the capital or the company got listed was he went and identified a global strategic player in Disney, partnered with them, and then eventually, when the company became $1 billion company, he actually sold his interest to Disney. And the reason I'm giving you this example, ladies and gentlemen, is because it shows that an entrepreneur goes through different cycles in the business evolvement itself. But at each cycle, he has to be resilient enough to take the right action as is appropriate at that point of time. So he went through it. He raised capital despite all the troubles. There was a time when in the iBanking circle, the famous words were that if Ronnie is coming to with the IPO, the market is going to, have a bearish turn. And it happened many times. Every time he came out, the market went bearish. Every time he came out, the market went bearish. So ultimately, he sold it for $1 billion and created huge amount of value for all his stakeholders. Go to the forward one. Meru was a superb company. It was the first private license that was granted. In 2011-12, Meru could have been easily sold for a multiple of the investment, and there was a queue of buyers for that asset. Unfortunately, at that stage, it looked like premature selling it. But nobody had seen that Ola and Uber were going to come into the market soon. So what was an invaluable company at one point of time, suddenly with the advent of Ola and Uber, became EBITDA negative. And eventually, it was not a great investment for TrueNorth. What would have been a phenomenal investment at one point of time became a relatively, less attractive investment at some point of time in the future. So all that I'm trying to say here by giving you the two parallel examples is that you have to be in tune with the developments in the market. And we always have to be open to the challenge of an alternate situation, challenging the convention. If somebody had thought through and realized what Ola would do to Meru, they would have never held on to Meru for as long. They probably would have exited it earlier. Similarly, if somebody had known that Oyo was going to come and cause so much disruption, perhaps people would have been less involved in building hotels and more involved in creating an app that allows them to sell hotels. So we live in a world which is ever changing. And in the last decade or so, the pace of change has dramatically moved upwards, ladies and gentlemen. We need to be far more nimble-footed. We need to realize that competition is coming from different directions and can be seriously challenging. And we need to be prepared for such challenges. So if you are in an existing business, be prepared to face serious headwinds because, and mind you, this is one of those eras, ladies and gentlemen, where you don't know where the headwind is going to come from. It can come from any direction. Unpredictable. You're living through unpredictable times. And if you are in a business where you think you are being entrepreneurial and creating new value, then rest assured that no status quo will remain status quo for a long period of time. I will only finish by saying, ladies and gentlemen, success eventually has to be determined in an absolute format, not in a relative format. Each one of us has to determine the barometer of success on which we are judging ourselves. They say that if your level of quotient of happiness is going to be dependent upon comparison, then you shall die an unhappy man. And with that, ladies and gentlemen, I shall say no more and move the call back to Kalpen.
Thank you so much, Ashok, for trying to condense the 3 decades of experience in around 45 minutes. We have many questions around wealth management, and you highlighted that you started this a decade back, and you feel confident only in the last 2 or 3 years that the strategy and the talent is right. So, the first question we've received is, how do you balance client centricity and distribution in current wealth management setup with so many new regulatory changes which have come? And the second question is, how do you balance profitability with client interest first, which is something that you apply across your businesses?
So, each organization, as I said, sets its own value proposition. And I would only say that it is time to look at your value proposition in the current context, in the world in which we live today. I can only say how I do it, and perhaps how I do it may or may not be exactly how others do it. For us, as I said, the centerpiece of everything that we do is our client. The question that I ask my people, is it in our client's interest or not? Because a proposition where you win and the client loses is an unacceptable proposition in Ambit. The proposition has to be client wins and I win. But honestly, even if client wins and sometimes I don't win, it is an absolutely acceptable proposition for me. Because as I said, I'm not in the business of trying to maximize my P&L for the current year. I'm in the business. The wealth business amongst all other business is perhaps the one business that has the longest gestation period, that is most dependent upon the reputation and trust that you build. And therefore, thinking ahead, always sub-optimizing your current proposition for what is right in the long term is the only way to build that franchise. People ask me a question to say, how is it that IIFL is so successful and monetarily successful, and yet they are so they built such a great franchise? Well, don't assume that they have done anything which is wrong. I'm not suggesting that if you follow a little more conservative position, you will always be in the losing side. No, not at all. As a matter of fact, you will always be on the winning side. My own experience of life has taught me that once it is established that what you do is in the interest of the client, and the client can trust you, respect you, and depend upon you, then profit and loss is a mere offshoot of all the capability and skill sets that you bring to the table. But between building trust and demonstrating skill set, I would say to you that building trust is a more important virtue to build a long-term franchise. And remember, businesses are only built in the long term. Profit and losses can be made and incurred in the short term. You also asked a question about distribution versus client centricity. It's a tough one. I mean, I have this discussion at all points of time with my colleagues in my own business, particularly given that we are all open to and influenced by monetary rewards. There is a bit of if I may say so, perverse incentive over here. Your compensation as an individual is dependent upon how much business you can drive. Your business you drive is really dependent upon the revenues that you bring in. And then how do you match the business that you bring in and what is right for your client? And again, I would say to you, ladies and gentlemen, that it's not about this year. Sometimes I would urge that you sacrifice your bonus for this year, you sacrifice your revenue for this year, if you think that it will serve your client better in the long term, because it's in the long term that you will really be able to monetize that relationship in a significantly greater and better manner than taking a short-term perspective.
Sure. Again, just connecting to the first point and the comment you made, that the last few years have given you confidence on Ambit's positioning in the wealth management space. So what were those key ingredients which you felt initially were missing and which have changed now for you to build that confidence and satisfaction?
I think, as I said, I was always very confident, Kalpen, that the opportunity in the Indian market is a large opportunity. The challenge was that, in the early days of the business being built up, wealth was largely consolidated in not I wouldn't say in a retail manner. Wealth was largely consolidated in few hundreds, thousands, probably lakhs lakh families. Unlike in the last 10 years, where it has, thanks to all the success in the market and all the success of the unicorns and all the stock options and equity, sweat equities that everybody's got, it's got significantly dispersed, and therefore that population has grown very, very large. That was number one. I think at some stage, my sense was that wealth management was a business where the client perceived inadequate value. See, at the end of the day, for us intermediaries to be able to create value in our businesses, our clients have to recognize the value that we bring to the table. Because in absence of that recognition of value, they're not going to pay you anything. And if they don't pay you anything, then you're, of course, doing pro bono service, as they say. And my own view is that clients have become more and more aware that investing wealth, first preserving wealth and then investing wealth, is not as simple as, kind of, I can run my business and I can do this myself. I mean, I remember going back 10 years when clients would say, "Yaar, मैं अपना धंधा चलाता हूँ, अपना पैसा क्यों नहीं manage कर सकता?" Well, if you are focusing on building your business, then let somebody else manage your money. And I think that recognition has come. It's still not as deep as I would want to see it. It's not as deep as is there in many of our peer countries. But I have no doubts that it is moving in that direction. So the recognition that a professional can add value in managing your business, in managing your wealth, is fast settling in. And that's allowing clients, whether it is in the advisory format or in the distribution format, that is allowing clients to accept that there is an outside wealth advisor and he ought to be a. And I would say the third, probably the most prominent thing that has happened in the last 2 years is all these unicorns, is the opportunity to invest money. Remember, from a time between 2000, say early 2000 to 2010, 2012, large pockets of investments, 1/3 of the investment went in gold. They didn't need an intermediary for that. 1/3 of the investment went in real estate. They didn't need an intermediary for that. Only a small part of the investment really went into capital markets, whether debt or equity capital markets. Now, with the recognition that perhaps real estate and gold are not as attractive as investing in financial products, that whole opportunity has become a much larger opportunity. So I would say recognition of financial markets, growth in the number of people, recognition that managing wealth is a full-time job and needs professionals, and those professionals need to be appropriately motivated, would be the three important factors that have caused the transition in the last 10 years. On Ambit's part, I think the recognition was that it's not a business that you can build unless you recruit somebody who is committed to that business, who understands that business and who wants to pursue a career just in that business. Unlike in a research function where I can move a research analyst and say, from the sell side, go to the buy side, or I can move a salesperson to say, from the sell side, no, go distribute my asset products. Unfortunately, in this business, unless you have spent years and built a serious sense of understanding and long-term motivation to build the business, you are not going to be adequately qualified. And therefore, finding that team, finding that individual, and recognizing that I can't just move a banker, I can't have my equities guy go run my private wealth business, but finding a team that really had a long-term commitment to the business and had the expertise and experience was critical. And we only found that in the last 2 years. So two failures.
You mentioned about Amrita coming on board and building it from here on. Just an extension to that, if you're looking at building a moat in the wealth management business, either generically or in your own business, where do you identify it? Either in people and talent. You mentioned about the role of talent and a global leader having to be a HR person first more than anything else. So is it talent first? Is it returns to investors, which is in a way value addition to the investors? Is it service standards? Or is it distribution, which means scale and more number of customers? So these are different levers. What are the levers which you think matter the most?
We are in people's business. And honestly, I know you're talking about it from perspective of pure wealth management, but I would say whether it is wealth management, whether it is asset management, whether it is equities, whether it is banking, We are in people's business. And again, from my own experience, I can say we had everything. We just didn't have the right people. So I would put people as the number one priority in any service-oriented business. Ability to recruit the right people, ability to retain the right people, and ability to motivate the right people. It's all three. We sometimes feel recruitment is done. No, you need to retain. And we sometimes feel retention is done. No, you need to motivate. It's all three factors added together that form the primary base of how you can build this or any other intermediary business. Of course, on top of that, you then need to have a very strong distribution arm. And we have seen what the power of a very strong distribution arm does. You need to have a very strong, we need to have a very strong technology today. I mean, let's not underplay the role of technology in this evolving world. I mean, what Zerodha is shown and what Navi is showing and what some of the other, asset managers and wealth managers are showing now is technology is and will continue to play a dominant role. Today's client wants simple, joyful experience. Earlier, joy used to come out of just seeing the returns. So long as I was told that my returns are good, I was very happy. Today, joy is far more than just looking at returns. Joy is timely communication. Joy is access in being able to get information when I want in the format that I want. And joy is onboarding. So if you can simplify all that by using technology, joy is critical to client service today.
Ashok, you've answered three questions, one shot, by extending the focus on people and then using technology as additional lever to build scale. And there were a lot of questions in terms of how can adoption of technology help in making this a very large success factor. Another question around how do you see full service broking businesses versus discount broking businesses? Where do you see the big trend in terms of success factors? Will it be clients going for discounts first? Will it be clients going for full service booking wherever value is offered? And what is the role technology would play in this trend? And we still have 8 minutes, and there are a few personal questions I also want to ask. Right now, I'm doing justice to all the participant questions.
So I would say that technology and using technology is going to be all pervasive. I don't think any business in financial intermediation has a choice other than to move up the technology curve. As I said, whether it is onboarding, whether it is on execution, whether it is on client information or communication, you have to leverage technology regardless. I think, it's an interesting question of discount brokerage firms versus full service firms versus, even more full service firm, because, full service firms can be, I will lend to you, I will execute for you. And then full service firm can be, hey, I have such great research. You need to read my research before you make your decisions. And I would say that the market itself will segment itself. Remember, there is the retail market. So mass affluent or very retail market. There is the high net worth market, and then there is the ultra high net worth market. And my sense is, just like in every other service business, let's take hotels, right? Hotels have understood the art of business hotels, luxury hotels, upper luxury hotels, and there are different clients. There are clients who would say Vivanta is the best value for money. And then there are clients who would say, I will not stay any other than Trident. And then there are clients who will say, listen, Oberoi or Four Seasons. So there is a segmentation that is happening in the market. There's no doubt that the discount brokerage is very, very attractive, both in terms of cost benefit, but equally they're volume dependent, not necessarily client dependent. I would say that business is here to stay. You can see it in the rest of the world on how discount brokerage leveraging technology have built huge businesses. Again, remember, the market itself is expanding dramatically, Kalpen. I mean, what percentage of India's wealth and what percentage of India's population is currently invested in the market? Tiny. And as that market itself expands, partly because people realize that financial products are key to their growth, clearly this segment is increasing and increasing and increasing. As greater and greater number of people come into the Indian middle class, they don't necessarily want to do only discounting. And if there is one segment which I think is vulnerable between the three segments, is perhaps the center segment, because the center segment, which is what I would call, I'm only an execution platform. I'm not a discount brokerage. I'm an execution platform. That perhaps is going to be squeezed from both sides, because as more and more high net worth individuals become ultra high net worth individuals, they want to go to these larger firms, boutiques that can provide them research, that can tailor research to them, that can provide them full service guidance. And obviously the mass affluent, as that population continues to grow, will continue to go to the discount brokerage. So I think each one will exist. Obviously the discount brokers are the ones that are growing the fastest, because that segment is moving into the market the fastest and from the retail brokerage. But all of them will exist. Perhaps the ultra high net worth and the discount more so, and the center one will get squeezed from time to time.
It's a matter of segmentation and then rightly adding value to each bucket. Is what you're saying. Very quickly, one question again, very relevant to Ambit itself. You're present in asset management in some way. You're present in wealth management as well. Do you see both making very strategic fits in terms of the direction and the view that you have of this industry in the future? How an integrated platform helps you do it in a better way?
So let me first answer this question from a different perspective. Do these platforms create conflict with each other? First, let's start with that conflict issue. And then the fact that you have a platform, and the fact that as a result of that platform, you have access to a much larger client base, because you are doing banking transactions for them, you're raising capital for them, you're covering them on research, they're participating on your sales calls or on your conferences. All that adds. I mean, in my view, a platform adds significant value on the client acquisition mode for sure. Skill sets have to be still developed uniquely and specifically to each business. If my sales team, if my equities team is doing some good framework on good and clean, the accounting framework, can my asset managers use that? Of course they can use that. So investment in one place is naturally available as a benefit to the other place. But there is no debate in my mind that a platform approach allows you much greater and effective client acquisition strategy. Question is there a conflict between some of them? And that's the first question that I get asked when I sometimes go with my asset managers to try and get empaneled. Some of the wealth managers unhesitatingly will ask me a question to say, what is the assurance that my client information will not be leaked to your GPC business? It's happened to me on 2 or 3 occasions, and I've given a very emphatic answer to say, no way, cannot be done. Because once I allow that credibility to be demolished, it's the same issue, right? If somebody can't trust you, as I said earlier, then why are you in business at all? So my sense is that there is some inherent conflict that needs to be addressed upfront. You need to have very deep Chinese walls with separate managements, perhaps sitting in separate locations, at least separate floors in the same building. And I think, listen, if you genuinely follow open architecture on both sides, which is what some of the more successful organizations, the Kotaks and the Edelweisers have done so successfully, there is no reason why there is not significant benefit from one to the other. So my wealth platform will sell the best-in-class products. And honestly, they will hold my asset managers and the fund managers accountable if they are falling behind the peers. They will tell them. And there was a period of time when we were selling more of some competitors than we were selling of our own product because the performance of some of the peers was better. So we follow open architecture. Both leadership teams know very well that the asset management team will empanel every single financial advisor and large distributor. And the GPC team will sell multiple products so long as they are all performance driven.
Sure, I have just 3 more minutes. First of all, I must admit that the good and clean idea was, in a way, a very unconventional thought. And we at DSP have been beneficiaries of that thought for having created a team separately focusing on that. So I must say thanks to you. My next question is, just give us 3 books that you have really liked the most and which you would like to recommend to everyone.
So I would say Black Swan. I mean, I can't stop reading that book, particularly after COVID came in. Nicholas Taleb. I've had the benefit. One of our investments is in a company called Teamworks that owns the Jaipur Literary Fest. So I've had the benefit of inviting there and spending time with him. And I have to say, he's a genius, absolute genius. Like all geniuses, he's a little unpredictable, but he's a genius. So I would say that would be my my first book. I would say Road Ahead by Obama, which is a fantastic book. I really enjoyed reading that book. And the Rise of Capital in by Thomas Piketty, I would say would be my 3 books.
So, thank you so much, Ashok. I have many more questions, but I'll have to take it offline with you on a one-on-one basis because we're running short on time. Thanks for sharing your experiences in a very lucid and simple way. And my 4 big takeaways: values, trust, be responsible, and people first. And people includes talent as well as investors. These are 4 very valuable messages that you've given to the audience today. To all of us who are in this business of other people's money management and fiduciary role. And thank you once again for sharing your 3.5 decades of wisdom and taking us through it. Thanks a lot. And thanks to all of you at the audience for asking so many questions. I hope next time we're able to add these questions and get more insights from Ashok. Thank you so much. Have a nice evening.